Something interesting is happening in the market right now, and it's not where most people are looking. While attention stays locked on megacaps and headline stocks, quiet positioning is starting to show up in smaller names that sit at the edge of major technological shifts. These are the kinds of stocks that don't move smoothly. They pause, they build, and then, when conditions line up, they move fast. Today, we're breaking down to U.S. stocks that operate in completely different sectors, but share one important similarity. Both are at a point where execution over the next several quarters matters more than past hype or past disappointment. Before we go further, a quick note: this video is for educational purposes only, and subscribing genuinely helps us continue bringing you deeper research-based breakdowns on emerging stock opportunities and market trends. Let's start with the first company, and I'll say this clearly. Most investors misunderstand what's really happening here. At first glance, this stock doesn't look impressive. It trades under $3, it doesn't dominate financial media, and it sits in a technology space that's gone through cycles of hype, skepticism, and disappointment. But when you step back and look at what the company is doing now, not 5 years ago, a different picture begins to form. The stock recently closed the trading day around $2.71 per share, reflecting sentiment at the 4 p.m. bell. During the session, it traded within a noticeable intraday range as buyers and sellers repositioned, suggesting active participation rather than neglect. That kind of price behavior matters, especially for a small-cap stock. It tells you this name isn't forgotten, it's being watched. This company operates in augmented reality hardware, specifically smart glasses designed not for consumers, but for enterprise, industrial, healthcare, logistics, and defense applications. That distinction is critical. Consumer AR has struggled because it relies on trends. Enterprise AR succeeds when it solves problems, reducing errors, improving workflow efficiency, and lowering training costs. Over the last several quarters, management has been deliberately shifting away from hype-driven narratives and toward practical deployments. Recent updates confirmed new volume orders for smart glasses, including deliveries tied to large enterprise and online retail customers. In parallel, the company announced defense-related contracts, including specialized waveguide components for military and industrial head-up display systems. These contracts don't usually generate explosive revenue overnight, but once approved, they often lead to recurring orders. From a financial perspective, this company is still unprofitable, and that matters. But losses have been narrowing, not expanding. Revenue has remained modest but stable, while operating expenses have been managed more tightly. Cash runway is a key focus here. The company ended recent quarters with over $20 million in cash and equivalents, providing flexibility to continue operations without immediate dilution pressure. Burn rate has been gradually improving as production efficiency increases and enterprise orders scale. This is not a growth at all cost story. It's an execution story. Leadership has reinforced that focus through organizational changes, including appointing executives specifically tasked with enterprise solutions and deployment scaling. That's a signal management understands the difference between building technology and selling it at scale. Only now does it make sense to say the name. That company is Vuzix Corporation. Vuzix has spent years building AR hardware while the market debated whether smart glasses were real. What's changed is not the technology, it's the customer. Enterprises don't buy concepts, they buy tools that work. From an institutional perspective, this stock still flies under the radar. It's not widely held by large funds, which increases volatility, but it also means future adoption could shift ownership dynamics quickly if revenue traction becomes more visible. Volume behavior in recent months has shown periodic spikes, often aligned with news releases or broader tech sentiment shifts. That pattern suggests speculative interest mixed with longer-term positioning, a typical setup for small-cap technology stocks transitioning from development to commercialization. Now let's talk risk, because this matters. Vuzix faces competition from larger players with deeper pockets. Adoption cycles can be slow, enterprise customers can delay rollouts, and profitability is not guaranteed. But the reward side of the equation is clear. If AR smart glasses become embedded in enterprise workflows, even modestly, revenue visibility improves dramatically. Valuation changes when recurring enterprise orders replace one-off shipments. This is not a stock that moves on hype alone. It moves on contracts, deployments, and execution. Now let's shift to the second company, because this one sits at the opposite end of the technology stack. This stock doesn't deal with what people see. It deals with what powers everything. As artificial intelligence, electric vehicles, and advanced computing systems expand, the limiting factor is no longer processing speed, it's power efficiency. Delivering more power with less heat, less loss, and higher reliability has become one of the most important challenges in modern technology. This company specializes in exactly that. The stock closed the most recent trading session at $8.59 per share, reflecting market sentiment at the closing bell. During the day, it traded between a low near $8.45 and a high around $9.31, highlighting significant intraday volatility and active participation from both traders and longer-term investors. That kind of price action often appears when a stock sits between momentum and consolidation. This company focuses on next-generation power semiconductors, specifically gallium nitride, GaN, and silicon carbide SiC technologies. These materials are increasingly critical in high-power environments, where traditional silicon struggles with efficiency and heat. Over the past year, management has intentionally shifted focus away from lower-margin consumer electronics and toward high-power applications, including AI data centers, energy infrastructure, and electric mobility. Recent earnings updates highlighted growing traction in data center power architecture, including alignment with next-generation AI factory designs. Distribution partnerships have expanded globally, accelerating adoption across industrial and automotive markets. Only now does the name come into focus. This company is Navitas Semiconductor. Navitas operates in a space where scale matters. Revenue growth has been accelerating, but the company is still investing heavily in R&D and market expansion. Profitability remains a future objective rather than a current reality. From a financial standpoint, revenue trends have shown meaningful year-over-year growth, particularly in higher power segments. Gross margins have been improving as product mix shifts toward premium applications. Cash reserves remain healthy, giving the company flexibility to continue investing in growth. However, burn rate is still a factor investors must watch closely, especially as competition intensifies in the power semiconductor space. Institutionally, this stock has attracted more attention than the first company. Coverage has expanded, and sentiment has been influenced by its alignment with AI infrastructure trends that brings both opportunity and risk. Volume behavior shows strong momentum periods, followed by consolidation, a sign of institutional trading layered with retail participation. The reward case here is clear. If AI data centers and electrification trends continue at their current pace, demand for efficient power solutions increases dramatically. Companies already integrated into that ecosystem benefit disproportionately. The risk is equally clear. Valuation sensitivity is higher, competition is fierce, and execution missteps can be punished quickly. So when you step back and look at both companies together, they represent two different but complementary types of opportunity. One is an early-stage enterprise technology adoption story, where execution can redefine long-term relevance. The other is an infrastructure-level growth story, where scale and efficiency determine winners. Both operate in markets that don't reward hype, they reward results. Both face volatility, both require patience. And both could see meaningful re-rating if execution aligns with broader industry trends. As always, stocks like these move fast, prices change daily. Always double-check current prices, review filings, and manage risk carefully. If this kind of multi-layer breakdown helps you see opportunities more clearly, make sure you're subscribed. It helps us continue delivering professional, research-driven market analysis without noise or exaggeration.